Okay, hello, good evening, good afternoon, good morning, wherever you are. Welcome to the Teachers College Student Loan webinar. My name is Matthew Camp. I am Director of Government Relations and Community Engagement, which includes alumni relations at Teachers College and a proud TC alum myself. And I'm joined by two teammates, Lauren Duncan. Hi, Lauren. And Steph Caballero. Hi, Steph, who work on alumni relations with me, and we're super excited to kick things off. And so just a few things before we get started about the TC Alumni and Community Engagement team. As mentioned, this includes alumni relations and includes the TC Take Action initiative. There are many ways under TC Take Action to get involved in the civic process, whether it's writing letters to your congressional and state representatives to advocate for important issues, to learning about those important issues, such as student loan forgiveness, which is a very important public policy that is changing from really day to day. I want to share a few upcoming events that are open to the Teachers College community, your friends, and anybody you want to bring, geared towards alumni. In Chicago, on July 14th, we have a really great event at the Shed Aquarium. And in August, on the 13th in New York City, we have an event for TC alumni, and again, open to the community, whoever you want to bring. And again, geared towards teachers getting ready to start the school year. This is in Morningside Heights, West Harlem, at the Baylander boat, which is docked right on 125th Street. So very cool location. And thanks, Steph, for adding those links in the chat. We hope to see you in person at either or both those events. Another save the date, August 27th through the 30th is new student orientation at TC. And we're really looking for alumni volunteers to help out with that. There's lots and lots of ways of volunteering with the TC Alumni Association. If you're an alum, you're automatically part of the association. We need people to help out with student orientation, with a new mentorship program, events like these. And so reach out to us if you'd like to step up. We would love to learn more about what you're interested in and how we could partner. Again, this is being recorded. We'll be posting and sharing this to other folks who could make it. And on to our workshop. We're so happy to be joined by the Student Borrower Protection Center. This is a nonprofit, nonpartisan organization focused on eliminating the burden of student debt for millions of Americans, including TC alumni. They engage in advocacy, policymaking, and litigation strategy to rein in industry abuses, protect borrowers' rights, and advance racial and economic justice. So check them out at protectborrowers.org, and they do amazing work. And they include as their outreach and advocacy manager, Amy Salata. And Amy has been at the Student Borrower Protection Center for 3 years. And I believe this is her third time joining the TC community. And we were just brainstorming how many tens of thousands of dollars that she has single-handedly helped TC alumni have their loans forgiven. I'm actually one of them, some close friends and relatives also. So we really hope that you'll join the ranks of folks who have learned how to navigate this sometimes arcane Byzantine process and come out ahead on the financial side. So I'll hand it off to Amy Salata. Thank you so much, Amy.
Thanks so much, Matthew. Thank you so much for having me, Columbia Teachers College. I'm so excited to be here today. My name is Amy Salata. I'm the Outreach and Advocacy Manager at the SBPC. We do anything and everything related to student debt through advocacy, policymaking, and litigation strategy. I'm really happy to be here with you today. We're going to cover a lot of topics, so get ready. But if you have any questions throughout the presentation, feel free to put them in the chat. They will be collected and we can get to them at the end. One note is that, if your question is like hyper specific or pertaining to your like individual situation, I might not be able to answer it exactly without knowing, the full situation, but we find that most questions can be answered using general program information. So feel free to ask, please ask. So Let's get started. There's a lot to go through today. So here's a general agenda of what we're gonna get through today. We'll talk about, what's new with debt relief, what has happened since we've all returned to repayment after the payment pause, something called the IDR account adjustment, public service loan forgiveness, which I'm sure is of interest to many of those on the call, a program called Fresh Start for folks who have been in default. We'll get to some important takeaways and reminders, and then have plenty of time for questions. So let's get started with debt relief. So you may remember that in late 2022, President Biden announced a debt relief plan that would have provided up to $10,000 or $20,000 in relief for some federal student loan borrowers. This program was knocked down by the Supreme Court last summer, as you may remember. That same day, President Biden announced that he was going to try to get debt relief across the finish line using the Higher Education Act. It's just a different authority. This required a process called negotiated rulemaking. Negotiated rulemaking is basically a process by which folks gather around the table and talk about what the parameters of debt relief might look like. It includes folks who have student debt, folks from higher education institutions, folks from the servicing industry, advocates, folks who work at nonprofits who are doing policy work. So all sorts of people kind of get together, meet for several sessions, and talk about what it might look like. This happened over the course of several months from October to February, and it ended in late February. And the first round of rules came out already for public comment. So they were kind of draft rules that folks could submit comments to. And we suspect a final rule will be issued sometime soon, hopefully this fall. I think Politico reported sometime in September, hopefully those rules will come out. And we're still waiting on a second set of rules that is around the question of hardship. So what does hardship look like? I think if you're on the call, you probably know that if you have student debt, that is in itself a hardship. And so this hardship piece, is also expected to come out in September for public comment. And then hopefully the final rule could be out as soon as October. But all this to say is that there's no action items for folks on broad-based debt relief in this very moment. We're still waiting on like some of these processes to kind of get completed. But hopefully in the fall, there will be more information and we'll know if there's like an application process or, who it'll be automatic for. And hopefully it's, big and bold because we know folks really need this debt cancellation. So that's it on debt relief, but happy to answer more questions at the end if you have them. Next, we'll talk a little bit about return to repayment. So you might remember that there was a payment pause happening for all federal student loan borrowers during the pandemic. This ended in August of last year, and payments were due in October of last year. There was this on-ramp period happening, and it's still happening. It lasts until September 30th of 2024. But basically what it means is that if you miss a payment or you miss several payments, you won't be considered delinquent, you won't be put in default, you won't be sent to credit bureaus. And so it gives kind of folks, after not making payments for 4 years, a little bit of an on-ramp to kind of get situated, sort out your budget so that you have some time to kind of, ease into payment. A couple things to note on this is that if you have been missing some payments, the interest on your account will continue to accrue, even though you've missed payments. And if you're seeking something like public service loan forgiveness, those missed payments will not count towards PSLF. And so, with PSLF, every month counts. We're going to go over that in a little bit. But, if you miss some payments, those won't count. One final thing on this front is that if you were in an income-driven repayment program or plan before the pandemic, you will not have to recertify your income until September of 2024, so in a couple months at the earliest. This is good news because most people's, income went up during the pandemic. And so this keeps your payments a little bit lower for, a longer amount of time. So saving you a few extra dollars, but you will have to recertify starting in September of 2024. All right, let's move on to income-driven repayment or IDR. So when you exit school, you have a 6-month grace period before you have to start repaying your loans. After that grace period, you're automatically put into something called the standard plan. That's this top left-hand corner. So this plan has you paying off the entire balance of your loan over 10 years. And so that means that your payment could be quite high if your loan balance is pretty high, right? So you're going to pay off the entire amount in 10 years. There are also some plans that have you paying it off over a longer amount of time, like the extended repayment plan or the graduated repayment plan. Those, kind of offer longer timelines, and the payments either could be very low over a period of time, or with the graduated repayment plan, could start out really low and then get really high towards the end. We're going to spend the majority of our time today talking about income-driven repayment, which is this bottom right-hand corner. Basically, your monthly payments are pegged to your income and not to the entire balance of the loan. And so they're often the most affordable option for folks. If if your income changes, you have to every year you have to recertify them to make sure that your income is up to date, so that they can calculate your monthly payment. But another nice thing is that, if you, became unemployed really unexpectedly, you could call and ask them to reevaluate your payment, and you could qualify for a $0 monthly payment. And so, these are often the most affordable plans for most people. Another really nice thing about income-driven repayment plans is that after you're in repayment for 20 or 25 years, you can get the remainder of your debt canceled. Um, and if you're in, the public service loan forgiveness program, that debt can be canceled after 10 years. And so these plans really keep your payments low and offer this option for cancellation after so much time has gone by, depending on what you're looking for. You can use the loan simulator tool available at studentaid.gov to get a sense of what you might pay under each of these different plans. There are 4 types of income-driven repayment plans that kind of fall under that umbrella. And so they're listed here at the bottom of this screen. The newest plan is called the SAVE plan, and we'll be talking a little bit more about that today. But these are all technically income-driven repayment plans, these 4. So if you're interested in income-driven repayment plans, you can go to studentaid.gov/IDR. You could also call your servicer and ask what your monthly payment would be under these plans, or enroll by calling your servicer as well. Now, this new SAVE plan was announced at the same time that debt relief was announced. So what it does is it basically protects more of your income. They raised the income exemption. So it used to be 150% of the federal poverty level. Now it's 225%. So keeping more money in your pocket. And then it also eliminates 100% of the remaining interest on your student loans after you make a payment. This is huge because we know that runaway interest was an enormous problem with student debt, and continues to be a problem. And so after you make a payment, you won't have any interest. The interest will be paid off on your student loans. Another thing is that it excludes your spousal income if you file your taxes separately from your spouse. So again, protecting more of your money in that calculation. 2 other really nice things that the SAVE plan does. This summer, folks who have only undergraduate loans will have to pay 5% of their discretionary income instead of 10%, which is what it was before. So it cuts your payments in half if you only have undergraduate debt. And if you have a mixture of undergraduate and graduate debt, it'll get you a weighted average of somewhere between 5 and 10%. So still protecting more of your money. And then the final thing that the SAVE plan does is it offers a shortened timeline to cancellation. So remember I said that IDR plans, you typically get cancellation after 20 or 25 years in repayment, or if you're in the PSLF program, you can get it after 10 years, but with SAVE in particular, it offers a shorter timeline. So you could get your debt canceled after 10 years of repayment, and if you had an initial principal balance of under $12,000. And this goes up on a sliding scale. So if you were in a repayment for 11 years and you had less than $13,000 that you initially took out for student loans, that would get you a shorter timeline to cancellation, shorter than that 20 or 25-year mark. One thing to note that is something that will be very noticeable during this presentation is that there have been a lot of things changing, and one of the things is the SAVE plan. A couple of lawsuits were filed by several state attorneys general, and unfortunately, a couple weeks ago, a federal judge blocked this piece of the SAVE plan that offered cancellation after between 10 and 19 years, basically in repayment. So this isn't an option as of right now. So you can't get your debt canceled between 10 and 19 years under the SAVE plan, but it could change. And if you already had your debt canceled through the SAVE plan, you won't have your balance reinstated. So happy to answer more questions at the end. I know this is constantly changing and could change as next week. This is true today, but it might not be true tomorrow. So just stating that, that it could change. Here are the eligible loans for the SAVE plan. You basically have to have a direct loan to enroll in SAVE. And if you don't have a direct loan, you could consolidate your loans to make them eligible for SAVE. If you were already enrolled in the repay plan, you've probably already automatically been enrolled in the SAVE plan, and everybody else can sign up at studentaid.gov/IDR or talk to your servicer. This is just an estimated monthly payment on the SAVE plan taken directly from Federal Student Aid's website. There's a lot of zeros on the screen. That's what we like to see. Those 0 monthly payments really count towards things like PSLF and towards those thresholds for cancellation. And so, that keeps more money in your pocket, and that's what we like to see. Okay, and then this is just a piece on the SAVE lawsuit. So, as I mentioned, 18 attorneys general sued the Biden administration over the SAVE plan, arguing that they really went too far with this plan. And in June, 2 federal judges issued different preliminary injunctions on the SAVE plan. The piece that's still in effect is just that piece that offers cancellation to folks who are seeking cancellation after 10 years, 10 to 19 years in repayment. But if you already had your debt canceled, it won't be reinstated. This is not true at the moment for PSLF. And so if you're, seeking PSLF, you're enrolled in the SAVE plan, you can still get, PSLF cancellation. It's just for those folks that have those lower balances and have been in repayment between 10 and 19 years. Happy to answer more questions at the end. Okay, so let's move on to something called the IDR account adjustment. Okay, so as I mentioned, if you're in an income-driven repayment plan, you have the right to get your remaining debt canceled after 20 or 25 years in repayment, depending on your situation. A couple of reports came out in 2022 that basically the servicers that were managing the IDR plans really had no way of knowing how far people were along towards that 20 or 25-year threshold. They were constantly putting people into forbearances and deferments rather than offering them income-driven repayment plans. And so, there was just a ton of mismanagement. And so the Department of Education announced that they were trying to rectify this. They were going to rectify the situation, knowing that there had been a lot of servicer mismanagement. So what this means is that there's going to be a one-time audit of all accounts. It's set to take place this September, and this is of all federal student loan accounts. Basically, they're going to be counting, different periods of time. So, if you had forbearances or deferments prior to the year 2013, you can get those to count. If you didn't make an entire, like a complete payment, but maybe you made a partial payment, they're going to count that time. And so this time will all count towards those 20 and 25-year thresholds. But also, if you're seeking PSLF, it'll be more time counted towards PSLF. And so really it's meant to get the maximum amount of credit on your student loans. It's not automatic. For most people it will be, but for some folks, particularly if you have some of these older loans like FFEL loans or Perkins loans. FFEL stands for Federal Family Education Loans. They were the main type of loan before 2010. So if you, went to school before 2010, maybe you have one of these FFEL loans and you need to consider consolidating to take part in this. It does have a deadline of June 30th here, but as I'll mention in a moment, it's a bit of a soft deadline, and so I can explain what that means in a moment. But again, all this time counts towards PSLF if you are kind of wanting to get more credit towards cancellation. So the deadline was June 30th to consolidate in order to get on track and get the maximum amount of credit through this IDR account adjustment. The Department of Education has stated that they are planning to do the adjustment on September 1st of 2024. The deadline of the 30th was really the way that they could guarantee that folks would be included in the IDR account adjustment. But it's possible that if you consolidated today, you could still kind of get the maximum amount of credit through this IDR account adjustment. So consolidation typically takes about 60 days to process. So, like it's possible that you could get all that credit, or you could, get slightly less credit. But if you need to consolidate anyway because you're seeking PSLF, which I can explain through in the PSLF section. You're going to need to consolidate anyway. So the sooner you do it, the more kind of opportunity you have to maybe get included in this IDR account adjustment and get even more credit than you would have otherwise. So I know this is a bit confusing, but I'm happy to answer more questions at the end too. This is going to be important both for the IDR account adjustment, but also for the Public Service Loan Forgiveness Program. Really, the first thing that you should do when you're trying to figure out what to do with your student loans is go to studentaid.gov. This is your clearinghouse for all things on your federal student loans. You'll log in and then you'll go to My Dashboard and look at your data. And so it'll look like this. What you're looking for on your dashboard is really like what type of loans you have. So here's a screenshot of the dashboard. You can see that this person has 2 direct consolidation loans. The word that's important here is direct. So they have 2 direct loans, and they had these other types of loans previously. You can see these options at the bottom, like Graduate Plus loans, Perkins loans, but they all have $0 balances. And so you know that this person, consolidated at some point. Now they have direct loans, so this is what it'll look like. One thing, so some things to keep in mind are these Perkins loans and these FFEL loans that I mentioned. They're the type of loans that need to be consolidated in order to access the IDR account adjustment. There are 2 types of FFEL loans, just to make it more confusing. There are FFEL loans that are held by the Department of Education and ones that are held by commercial lenders. If you were receiving the payment pause, so you weren't required to make payments on your loans, then you have one of these education department held FFEL loans. And if you were required to make payments during the payment pause, then you have one of these commercial FFEL loans. Another way to look is to look at your dashboard and see who owns the loan. So you can see this second box here says that it's owned by a private lender, and the last block says that it's owned by the Department of Education. And so the distinction is really important because those with commercial FFEL loans are the ones who absolutely must consolidate in order to access this IDR account adjustment. And as I mentioned, the timeline is a bit sticky. And so if you know that you're one of these people, it might be a good idea to consolidate sooner rather than later to ensure that you get kind of captured in this IDR account adjustment. Okay, so let's just review what should happen in terms of the IDR account adjustment. So check what type of loans you have by going to studentaid.gov. If you don't have a loan that is currently held by the Department of Education, you could consolidate your loans to try to get into this kind of time frame for the IDR account adjustment. The Department of Education has already begun canceling debt. When you see every so often that the Department of Education or that President Biden has canceled so much debt, over a certain amount of time, it's usually happening through this IDR account adjustment or through PSLF. It was happening previously under the SAVE plan, but I'll just say that things are moving and they're moving in the right direction. It's good to see these these policies actually working in real time for folks. Remember that this is set to take place in September, that this deadline of June 30th is, a soft deadline in some ways. But the sooner you consolidate, the more likely, you'll be able to kind of participate in this IDR account adjustment, keep keep credit towards times that you were in forbearances or deferments, in the past years. Okay, so let's move on to public service loan forgiveness, which I'm sure interests a lot of folks on the call. So basically, public service loan forgiveness is a program that provides debt relief after 10 years in repayment. There are typically 4 requirements for the PSLF program. The first is that you have to have the right type of loan, which is a direct loan. Direct loans have been the main type of loan that has been issued by the government since 2010. So if you went to school, since 2010, you likely already have a direct loan if you have, federal student loans. Remember too, that if you don't currently have a direct loan, you can consolidate to make it direct and make it eligible for public service loan forgiveness. The second requirement is that you need to be in the right type of repayment plan. For most people, that will be an income-driven repayment plan. So, those are the 4 plans that I mentioned at the beginning of the call. You'll also get this slide deck at the end, and so you'll be able to kind of come back to these slides to reference them. But for most people, it'll be an income-driven repayment plan. You can also stay on the standard plan, but remember that the standard plan has you paying off the entire loan over 10 years anyway. And so income-driven repayment plans are, they often offer, lower payments so that you're not making such high payments over 10 years. And the next requirement is that you have to be in the right type of employment, which is working for a public service employer full-time. And that's defined as 30 hours a week. It doesn't matter if your employer says that full-time is considered 40 hours a week. For the purposes of PSLF, they are able to sign a form if you work over 30 hours a week. And you have to work for a public service employer. So that is any level of government, so federal, state, local, or tribal governments, any 501c3 nonprofit, and certain other nonprofits. So if you have folks on the call who, work for a school district, or maybe you work for a nonprofit charter school, maybe you work for a university that's, a nonprofit university, these are all examples of public service employers. And so it's just a matter of kind of, submitting your paperwork, and then they have a track record of, what your employers were and how often or how long you worked there. And then finally, the last requirement is that you need to make the right number of payments, which is 120 payments or 10 years worth of payments. And you have to make those payments while meeting all the other requirements. So it's 120 payments on direct loans while in an income-driven repayment plan, while you're working for a public service employer at the same time. So these are the general requirements for PSLF. One really nice thing is that while we had the payment pause, all of those months have counted towards PSLF. The only caveat is that you needed to be working for a public service loan forgiveness eligible employer during that time. And so as long as you were working, for those, 4 years or whatnot, 3 years, you can, all those months can count, and that gets you more time towards PSLF that you essentially didn't have to make payments for. So that's really good news for folks. So, basically the PSLF program and the IDR account adjustment are interacting at this moment in time. Folks still need to consolidate if they don't have those direct loans, and they still need to submit their PSLF paperwork using the PSLF help tool. But essentially you can get, if you previously didn't have a direct loan or you previously weren't on an income-driven repayment plan, it's a good time to fix those issues now and get on track for PSLF. Because again, you could still, be counted in the IDR account adjustment, especially if you act today. So I wouldn't waste any time. Go to studentaid.gov right now while we're on the call and figure out what type of loans you have and if you need to take any action steps. So remember, it's not a guarantee, but if you don't have direct loans and you know that you want to pursue public service loan forgiveness anyway, you'll need to consolidate. And so it's just a matter of like how much credit you might get in consolidation, which I'll go over in a moment. Okay, so on July 1st of this year, some changes went into effect on different programs. One of those programs that was affected was the PSLF program. So previously, prior to, let's go back in time, to before the pandemic, let's say, if a person consolidated their student loans because they didn't have a direct loan, which is one of the requirements of the PSLF program, but they were a teacher and they wanted to get PSLF because they wanted to get their debt canceled after 10 years, they had to consolidate, right, to get a direct loan. If you did that, you lost any credit you had gained towards cancellation. And so that was really frustrating for folks because often servicers wouldn't have told them that they needed to consolidate in order to access this program. And so they lost all the credit they had gained. So if they had been a teacher for 5 years, making payments for 5 years, but they found out they needed to consolidate, they lost all that time towards PSLF and had to start the clock at 0 again. Now they changed this, because they recognized that that was really burdensome and awful, right? And so now folks will receive at least a weighted average of qualifying payments on direct loans. And so, this, math gets a little bit complicated, but at least it gets you more, more credit towards cancellation under PSLF than it did previously. And so say you had a FFEL loan and you had a direct loan, basically they'll take like a weighted average between the payments that you made on that direct loan, and say, say that's all you had, and then this fell loan counted as zero, they would basically take a weighted average of the payments that you made on that direct loan. And so at least it gets you more credit than it did previously. But, again, this IDR account adjustment, and if you kind of take action today, you could get counted in that to get you the maximum amount of credit, so that when you consolidate, you wouldn't lose any credit. You would only gain credit. And so happy to answer more questions at the end again on this. I know there are a lot of moving parts here. Okay, to make matters even more complicated, there is currently a PSLF processing pause that's happening right now. So it's happening from May 1st through the end of July of this year. And during this time, there's a couple things that'll be paused. So basically, if you submit a form, they're not going to process your form until after the pause ends in July, or in August, I guess. They won't be updating any of your payment counts, and no one will receive cancellation under PSLF, until at least August. Essentially, this is happening because the platform is shifting from Mohila, which is one of the servicers, to studentaid.gov. And so before, you would log on to your Mohila account, see, your updated payment count, and how much progress you had made towards PSLF. But in the future, as of August, you'll be able to log into studentaid.gov and see your progress there instead. So yeah, it's hopefully, it's not too much longer. So hopefully, if you are really close to that, threshold of getting PSLF, it won't be too much longer for you. And just to note too, like, you can still submit your forms, your PSLF forms. It's just that they won't be processed until after the pause ends. Okay, one quick note on Parent Plus borrowers. So Parent Plus loans are loans that parents take out for their children's education, but it's in the name of the parent. And so, it's on their parent's account, but it's for, their children. Parent Plus loans have been kind of excluded from all sorts of things historically, without really rhyme or reason. But some good news is that they, advocates got Parent Plus loans included in the IDR account adjustment. And so if you have a Parent Plus loan, you were able to get more credit, towards PSLF and cancellation through this IDR account adjustment. The action items are very similar. You still need to submit PSLF forms, making sure that the government knows where you've worked and for how long, so that they can count your credit. But another option for folks that are Parent Plus borrowers is that you can consider consolidating to get on an income-driven repayment plan. This gets a little tricky because the only income-driven repayment plan that Parent Plus borrowers are eligible for right now is the ICR plan, the Income Contingent Repayment Plan. And that is the least generous of the IDR plans. And so those payments can be quite high and, pretty unaffordable for folks. And so it really will come down to whether it's, more affordable to get on the Income Contingent Repayment Plan or stay on the standard plan, knowing that we've had, 3 years of non-payment, and see which one is more affordable to stay on, for the remaining time that you're either seeking PSLF or trying to get, maybe you're trying to get income-driven repayment cancellation, in which case, you'd have to consolidate to get on the ICR plan. So it's a little tricky, but those are just some notes on Parent Plus borrowers, given that they are a little bit different. Okay, so let's just recap what to do if you're interested in public service loan forgiveness. First, check what type of loans you have by going to studentaid.gov. Direct loans are one of the requirements, so you have to have a direct loan. So if you have a non-direct loan, so maybe you have one of those FEL loans I mentioned, or a Perkins loan, they need to be consolidated in order to access PSLF. So the first step would be consolidating those loans. Next, you could use the PSLF help tool. This is also at studentaid.gov, to get credit for all of your eligible public service employment. So you can submit forms for any period of time since October 1st of 2007, when the program began. And so that's a lot of time that you can potentially get credit for. If you have Parent Plus loans, think about consolidating to get on an income-driven repayment plan, or weigh whether that's more affordable to stay on the standard plan at this point. Remember, you can still submit forms right now, but they just won't be processed until August at the very earliest. All right, let's move on to Fresh Start. This is the last kind of bucket of information before we get to to takeaways. And so Fresh Start is really a way for folks to get out of default. You enter default after you have not made any payments for 9 months. And at this point, it really affects your credit. It, prohibits you from getting a car, getting a house, all sorts of things that you need, a good credit score for. And so Fresh Start is really meant to be a faster, easier way out of default. And basically it restores your repayment options. It allows you to go back to school and get more aid to go back to school, Title IV aid, if that's something that you're interested in. It also restores your rehabilitation option, which is a way out of default. It's pretty onerous. It takes about 10 months. You're heavily monitored to make sure that you can make payments. And so it restores that option if you use it during the payment pause. It also restores your credit and it protects you from involuntary collection. So if you're in default right now, it's a really good time to be considering getting out of default because it's much easier than it could be in a few months. Basically, folks have 1 year until after the payment pause ends to take one of two options. It's, two action items. So the deadline is August 30th of 2024 to do one of the two things. The first option is you could communicate with the default resolution group by calling this number or your guarantee agency and request to enter a repayment plan. It's really that simple. It's just requesting a repayment plan. And then the second option is you could request financial aid at an eligible school. And if you do that, your school will need to get a signed statement from you just saying that you agree to be placed with a non-default servicer. And so pretty easy options. Those are your two options, and you have until August 30th to do them. If you don't do one of these options, you'll be placed back in default using the original date of your delinquency. And so it's really good time before August 30th to get out of default and start getting back on track. Okay, I know that was a ton of information. Let's go over some important takeaways and then we can get to your questions and important deadlines. So first, what type of loans you have, and see, what type of loans you have at studentaid.gov to check your eligibility for different programs. Remember you need direct loans for the Public Service Loan Forgiveness Program. And if you have one of these older loans, then you won't get as much credit towards the IDR account adjustment that will happen in September. You could check out the loan simulator tool at studentaid.gov to figure out what your monthly payment would be under different payment plans if you're interested in income-driven repayment. If you need to consolidate your loans. So if you currently don't have direct loans, but you're interested in PSLF, and you know that that's the way that you want to get out of your debt, then remember that you have to consolidate your loans. It takes about 30 minutes online. It's not very difficult, but it takes about 60 days to process. Use the PSLF help tool available at studentaid.gov to log all of your employers. And basically it'll send your employers an email that they then have to electronically sign. It's pretty easy. If you're in default, take one of the action items to get back on track and participate in Fresh Start. And then finally, the last two things are really important. As you can tell from all the red asterisks in this presentation, there are a lot of things that are changing every day. And so please beware of scams. There's going to be a lot of people looking to take advantage of folks right now. So make sure you're getting your information from trusted sources like studentaid.gov. We also have a borrower resource called cancelmystudentdebt.org that we try to update pretty regularly, especially at least with banners. And we're adding a page on the website to include some of the lawsuit stuff so that, as it changes, we can update it pretty quickly. So just please beware of scams. In all likelihood, if something were happening with your student loans, the Department of Education will, email you. They won't call you. If someone calls you asking for money to get your debt canceled today, that's likely a red flag for a scam. Finally, file complaints if you experience any issues. You can file complaints with the Consumer Financial Protection Bureau, with federal student aid ombudsperson in the Department of Education. And also some states, including New York, have state ombuds persons at the state level. We keep a list of those on our website as well. So you can reach out to your state ombudsperson if you need more help or if you have an issue. And you can also, file complaints with all three. It doesn't hurt. And it really like helps shape the policy of the future. Policymakers often go to these complaint databases to see what the most common issues are and how to fix them. Okay, finally, there's just a list of important dates here. So remember the PSLF processing pause is going to end at the end of July, and then hopefully you'll be able to see your updated payment counts and all sorts of things related to PSLF after the 31st. The fresh start period will end August 30th, so if you're in default, take advantage of this time right now. In September, they're supposed to run the IDR account adjustment, so you could see more credit added to your account, like forbearances and deferments, giving you more time towards those, thresholds for cancellation. The on-ramp will end on September 30th, so if you haven't been making payments right now, you won't kind of experience some of the penalties that you might have otherwise, but that'll change after September 30th. This fall, hopefully we see more debt cancellation that's broad-based, that's bold, that's automatic. And then finally, just keeping in mind that these lawsuits are ongoing and they are, a pretty serious threat. And so making sure that you're, kind of keeping up to date with what those outcomes are there too. Okay, let's get to your questions. Thanks so much for your patience. I will pass it over back to the Teachers College folks.
Yeah, so I was pulling all of the, first off, thank you so much, Amy. Every time you do this, I feel like I learned something new because things change and it's really helpful. I was gathering questions from the chat as this was going on, and I've kind of put them into categories. So I'm going to go through these each by category. If you have other questions that come up during this, feel free to continue to put them in the chat as well. And we will get to them once we get through this first round of questions. If we don't get through all your questions in the next 10 minutes, we will continue to get as many answers as we can and send them answers out in a follow-up email. So the first couple questions are about loan consolidation. So what if you missed the deadline of June 30th to consolidate your loans?
Okay, so if you missed the deadline of June 30th, but say you really need to consolidate, like if you know that you want to, all right, let's look at it this way. Let's back up a little bit. So if you have student loans, right, you're either in a place where you're going to pay off your student loans, or you're going to be trying to get cancellation through one of these programs, right? Like, so if your loan balance is incredibly high, like mine, I'm seeking PSLF. And so I know that I'm not going to be able to pay off that balance. And so I know that I need to kind of meet the requirements for PSLF and get on track for that, because that's the only option. So if you are one of those folks that is seeking PSLF and you don't currently have a direct loan, you know that you'll need to consolidate in order to get on track for PSLF to get a direct loan and then meet the other requirements. So if you're one of those folks, if you consolidate it today, it's quite possible that you could be included in the IDR account adjustment, meaning that you might get some of your past periods of forbearances or deferments to count towards that PSLF time. The other option is if you didn't quite make the deadline and Ed can't, kind of include you in this round of the PSLF, or I'm sorry, in this round of the IDR account adjustment, you might get a weighted average on your loan. So say you have a mixture of FFEL and direct loans, you'll get like the payment counts for your direct loans, but then you won't like the other loans will kind of be counted as zero. And so say you made like 30 payments on a direct loan, and then your FFEL loans count as zero, you'll get like 15 months towards PSLF in that case. So you can still get credit, and in some cases, it might be your only option to kind of consolidate, or your best option, right, to consolidate anyway. So it is possible to still get credit, both through the IDR account adjustment or like just kind of under the PSLF program generally.
Okay, awesome. Thank you. Sorry, I'm going to skip this one because I think it was just answered. So, these are a lot of these are going to be about loan forgiveness. So if we're seeking PSLF forgiveness and we were put in save automatically, does this affect our chance for forgiveness?
No, as of right now, as of this very minute, it does not. So essentially, if you're seeking PSLF, being on an IDR plan is likely more affordable, and SAVE is one of those IDR plans. And you're still able to get PSLF cancellation, even if you're on SAVE. It only affected those folks that have lower balances. The lawsuit only affected those folks that have lower balances and were seeking cancellation between 10 and 19 years. You can still get PSLF through the SAVE, like while being enrolled in the SAVE plan at this moment in time. This could change, but as of today, it's true. And so I just want to, this is why it's, unfortunately, folks need to be very vigilant at this time. That's really unfortunate, but it is true. And so just kind of keep, checking the news on these kind of SAVE lawsuits that are kind of moving through the courts right now.
Great. What happens if we do not repay the loan under the standard repayment plan in 10 years? So I think this question is, can you still qualify for PSLF if you don't make the 10-year payments within the calendar of 10 years?
Well, so with the standard plan, you will have to like pay off your loan in 10 years. So there really isn't an option to not pay off your loan in 10 years. Those like that's how it's like set up. So so that's kind of an impossibility, but I think like, if you're seeking PSLF and you're yeah, I mean, say you miss a couple of payments and you're on an income-driven repayment plan, but you're still seeking PSLF, those months might not count moving forward, right? Because you missed payments, but it'll just extend your time a little bit. So it's just, basically 120 months of payments while working for an eligible employer. So even if that timeline is a little bit longer than 10 years because you missed a few payments, it still is a shorter timeline otherwise. I hope that answers your question because I know that was a little tricky with two different payment plans.
So these two questions kind of go together. So we were talking about the payment pause during the pandemic. So if do those years qualify as years towards PSLF?
Yes.
And someone in the chat just says, how do I get the pause COVID-19 payments to count towards PSLF?
The way you would get them to count is just by submitting your PSLF forms using the PSLF help tool at studentaid.gov. They should automatically count as time as long as you were working for a public service eligible employer during that time.
Great. And then someone is saying, I'm still paying during the PSLF pause. Will those payments count? Yes.
Yeah, this is a good question. Yeah, so if you're still paying your loans during the PSLF processing pause, which is from May to July of this year, that's good because that time will count towards PSLF. It's just that they're essentially like not processing anything right now. That doesn't mean that like you won't get credit for that time. It's just a kind of like a technical issue basically.
Great. A couple of people have this question: does working at a school or a university, something that would normally count for PSLF, outside of the US, make any difference in qualification?
Yeah, this is a good question. I think basically if you're working outside of the US, I think that it still would need to be a 501c3 registered in the United States. Unfortunately, like if it's not registered in the US, then I don't think it would qualify.
What if we completed the PSLF paperwork before, Mohila moves to another servicer or the next move? I know these continue to happen. Do we need to complete or submit the paperwork again, or should that be automatic?
It should be automatic, but we know that there have been many, many issues with Mohila as a servicer. And so this also requires a bit of vigilance. And so I would keep copies of all your forms. If you use the PSLF help tool, it should kind of be automatic because it's, it was just like, done electronically, but I would just remain very vigilant and make sure that your payment count is correct when you get a new servicer or when it transfers, when it transfers to studentaid.gov. Just to make sure that it's right, because we know that they've made a lot of mistakes, and so yep, be vigilant.
Great. So this one is more of a personal specific situation, but I'm going to ask it like a general one. So it's saying the loan is 49 years old, paid on and off. Is there a chance this loan could automatically be canceled based on how old it is with the new guidelines?
Yes, it sounds so. If your loan is over 25 years old, essentially the IDR account adjustment is meant to fix that issue. No one should have a loan that is 49 years old. That that just shouldn't exist, because you should have had it canceled under the law. And so, you know, it should get captured in the IDR account adjustment. If it didn't, maybe it means that you didn't consolidate your loans. So perhaps consolidating is a good idea to try to be caught in the IDR account adjustment. But even if not that, I know that this is a piece of the broader, debt relief kind of question on hardship, and folks that maybe didn't know that some of these programs existed, or that you could have gotten your debt canceled after 25 years. And so I know that they're like looking to capture some of those folks. So those are my two ideas. I think like in no way should you have had a loan for almost 50 years.
Great. I'm trying to, we need to pause in just 1 minute to wrap up. I'm just going to try to get through as many of these as I can.
Sure.
Could future policy political changes impact PSLF if you're in the middle of the process? Basically, could that program be eliminated while you're trying to pay off?
Yeah, this is a good question. I mean, I think that there are always risks with all these things, but with PSLF, it was really a bipartisan program. Folks on both sides of the aisle were really into it because it got more people into the public service. We needed more folks working in the public service, especially teachers, right? And so I think the risks are a lot less with PSLF that something would happen to it. And it was also an act of Congress, and so that would be a lot harder to change, rather than like something like an executive order. And so, yeah, I think mostly safe, I would say, but of course there's always a risk.
And then in the similar vein, what is there any effect from this summer's Supreme Court decisions around substantially weakening federal agency regulations? Could that potentially have any effect on federal loan policy?
It's a really good question. I think that advocates, have kind of considered that this might be an option, that like, the Chevron doctrine, wouldn't exist anymore. And so we haven't been relying on it as a way to get student debt cancellation, and for other programs too. And so like, of course it's a risk, but I think folks haven't been relying on it, as like the sole argument that's like that debt cancellation should happen, or that, other changes should be made. And so I think there's like less likelihood that that would affect student debt issues.
Okay, I know that we are about to have to, and I'm gonna ask one more question that I think is a really good one for everyone to know. Do we need to call studentaid.gov or a new loan servicer to confirm if we qualify for one of these relief options? And I think I know the answer, but I want to make sure that you say it right.
Yeah, so I think if you're interested in some of this stuff, or any of this stuff that I mentioned, go to studentaid.gov and log into your account. That's how you figure out what type of federal loans you have, and that affects your eligibility for different programs. It'll also, you'll figure out if you need to consolidate or not, and you'll have this slide deck as a reference so that you can, figure that out. You could also call your servicer. I think sometimes servicers don't give out the best information in our experience. And so really sticking to studentaid.gov and figuring out where to go from there is really the first step to figure out your eligibility for these different programs.
Great. I'm going to pass it back over to Matt to close us on out. I just want to like re-emphasize one more time. If you are asking questions in the chat and you have my name listed, that is my fault for sending you a direct link that comes through my name. I can follow up with you with as close of answers as we can get to these questions. If you just make sure to give us your actual name, we will of course try to put as many of these in the follow-up email as possible. But just please make sure to let me know. I have a few people have already given us that. Also, if you're asking a very personal situation, we are going to do our best, but Amy and our team are not, we aren't able to give you direct advice on your current situation. We can direct you to all of the resources and what the regulations are. So just want to make sure that that's super clear. So we can direct you to those resources. Okay, Matt, all yours.
Yeah, and if your question hasn't been answered, here's my email address. Just email us, and we'll consolidate the questions and try and get back to all of you. So please do that. And but yeah, we want to make sure we are mindful of our hour slot and Amy's time, and we'll certainly try and answer everyone's questions. So just a few closing notes. I mentioned great ways to stay in touch. We are in need of alumni who want to serve as mentors. So Steph, is this a good time to share the sign up link, or can we follow up with that? Great. So this is the sign up for if you would like to join the TC Alumni Mentorship Program. And I mentioned the New York City and Chicago happy hours or getting together in person. This is the New York one, and here's Chicago coming up in the summer. And other things to close us up. Again, we will follow up with this recording with Amy's presentation with all the good links and answers to hopefully every one of your questions. So I think that's all we have to close up shop. It is 5 o'clock Eastern. I want to thank Amy again so much for your time. Thank you, Steph, for judiciously handling all these questions, and Lauren for your support. So we will be in touch, and let's stay in touch. Reach out to us if you need anything. Thank you, everyone who's joining today. Take care.